I'm inclined to believe that if there's room in the economy to let interest rates drift higher, that if that occurs, I'm not saying it will, I'm no economist, but if they do, it wouldn't surprise me to see decent relative strength in the US dollar and a softer metals price. Not a prediction, but it wouldn't surprise me. I watched a similar circumstance in 1975. I'm probably one of the few people around that experienced that one personally. But it doesn't really matter in the longer term. I suspect that if they allow interest rates to go up, you'll see more carnage in the bond market. You'll see more carnage in single-family residential. You may begin to see carnage in the equity market. And my suspicion is that both the voters and the political class will lose their nerve and cause the Fed to have to lower the interest rate. If that happens, and I can't tell you when it will happen, we will send a signal to savers and investors around the world that the American midterm elections are more important than the sanctity of the US dollar. And if that happens, I think that you'll see a rally in gold and silver that will surprise people, very similar to the one that we had in 1975. So if I had to guess, sadly possessing no crystal ball and not being an economist, stable to higher interest rates will keep gold soft until the U.S. political class changes their nerve, which I suspect they will. When they lose their nerve and take interest rates lower, the impact on gold will be strong. My suspicion is the strength you've seen in gold in the last couple of weeks is due mostly to this bizarre move between the United States and Japan, where the Japanese had ample reserve to defend the currency themselves. But the U.S. government, rather than having Japan sell its existing U.S. treasuries, printed more U.S. dollars out of thin air. In other words, counterfeited them, basically. And lent them to the Japanese in order to defend the yen without having to sell their U.S. treasuries. I think that spoke volumes to those investors who bothered to pay attention. That's the only thing I can draw from it. Clearly, the Fed's own calendar, or rather the Treasury's own calendar, the fact that they have to refinance a lot of debt and they have to fund an ongoing deficit, and a war, suggests that competing for bids in the aftermarket with the Japanese, a forced seller, wasn't a pleasant. Why else would you say to the Japanese, who have ample foreign reserves, that you will fund a problem that they have their own funds to solve? Let's say that you had a relative, and this relative had some spending need, and they had a bunch of money in the bank, but you said to them, rather than use your money, why don't you use mine? How does that make any sense at all?
For many experienced investors, gold isn't treated as a trading asset. It's treated as financial insurance. Unlike stocks or bonds, physical gold isn't someone else's promise to pay. It's a tangible store of value that's preserved purchasing power across generations. Recent years have only reinforced that view, as central banks around the world keep buying gold in bulk to diversify their reserves. Rather than chasing short-term price swings, long-term buyers tend to accumulate gradually, betting that inflation and expanding government debt will eventually weaken fiat currencies. Their strategy comes down to preservation, not prediction, during uncertain economic times.
I think you need to understand it's a speculative asset class, that it tends to outpace gold in both directions, up or down. It tends also to be very volatile. And many speculators correlate risk to volatility. That's not right, by the way. Volatility and risk are very different phenomenon. If you are a skilled investor, what volatility represents is opportunity. If you're an unskilled investor, your own reaction to volatility makes volatility a risk. But people who want to concentrate in the silver space need to understand that they're entering into a financial rodeo, and they need to further that dialogue, take real care that they don't get bucked off. Yes, but not all. I think I put my portfolio in three buckets: savings, where I have physical gold; investments, where I have the best of the best miners. A small number, and then speculation. Over the course of the decade of the 70s, the best quality gold miners delivered about twice the returns that physical gold did. Very handsome, albeit with broader swings and operational risk. The speculations probably doubled or tripled the return, high quality speculations that were exhibited by the best miners. But with the speculations, you have to do work. And that's where most people fail. I've said in the past that if there are 3,000 junior mining companies in the world, probably 2,500 of them are valueless. So if you seek the alpha in speculative returns, if you seek to be a speculator, you need to be risk tolerant, but you also have to be work prone. A lot of people look at the returns that certain speculators, myself included, have achieved. They want access to those returns, but they don't want to put in the hours or take the risks. My great colleague, the best mining stock speculator I know, Eric Sprott, experienced in the 2010 to 2014 meltdown what was probably an 85% decline in the value of his portfolio. Interestingly, I was very close to Eric at that point in time. He probably experienced a 6-week grief period. And then he sort of shook the dust off and said, well, how do I get that 85% back? Went back to work. There are not many people who are that psychologically durable. There's also not many people who are rich enough to take an 85% haircut and keep ticking. But I think Eric's response was very, very, very useful. And it's worthy to note that not only did he recover the 85%, he did substantially better. But most speculators shouldn't equate themselves to Eric Sprott. Most speculators don't have his nerve. They aren't willing, particularly his age, to work as hard as he does. He works like a troll. And most people don't have the psychological wherewithal to see on a bad day your portfolio down 7 or 8%, on a bad week to see it down 15%, and say, "Oh, shucks."
Whether or not the more dramatic predictions actually play out, today's financial landscape is clearly shifting. Central bank gold buying remains elevated, government debt keeps expanding, and investors are increasingly questioning long-held assumptions about wealth preservation. Rather than expecting the next decade to mirror the last, many analysts believe the tension between hard assets and paper assets is only going to intensify. Gold and silver won't solve every economic problem, but they continue functioning as a kind of gauge for confidence in the broader monetary system. As markets keep evolving, understanding these forces could end up mattering just as much as tracking stock prices or interest rate decisions.
Well, Japan is probably unique in the sense that they're experiencing more downside volatility in their currency and they're solvent. I don't know that we have other countries in our sphere that both are experiencing the same level of downside relative to the US dollar and also have the ability to fund the solution themselves. Certainly we extended a helping hand to Argentina, but we extended a helping hand to Argentina because they were empty. The Japanese weren't empty. They had the ability to solve the problem themselves, but we decided to solve them anyway. Our president says, out of friendliness. I hope if sometime in the future I experience some difficulty, that the president feels friendly towards me. Yeah, Maggie, I save in gold. I maintain liquidity in US dollars, but I save in gold. As you know, I failed retirement completely. And as I have income, which mercifully I do, I use part of it to buy gold with every influx of liquidity. You were just at a conference that was pretty profitable. When all of the expenses of the conference have been settled and the employee bonuses have been paid, a substantial amount of the money that's left over, that money which comes home to Papa, the owner of the conference, a substantial amount of that will go into gold, almost irrespective of price. I personally expect the US dollar to lose about 75% of its purchasing power over the next 10 years. And I expect the nominal price of gold, which is to say the US dollar quoted price of gold, to reflect the deterioration in the purchasing power of the dollar. I can't give you an exact gold quote because I don't have one. But I suspect over 10 years it'll be markedly higher. The consequence of that is that if gold's at 4,400, I'm a buyer. If it's at 4,600, I'm a buyer. If it's 4,700, I'm a buyer. So personally, it's in my interest to see lower gold prices since I will be a buyer and I won't be a seller for a substantial period of time. Many of your viewers, of course, look at things differently. They're concerned about the price of the metal that's already in their inventory. And the consequence of that is that they want higher gold prices sooner. I would say to them only, be very careful what you wish for.
Why is that?
The set of circumstances that takes the gold price higher is invariably painful to the rest of your portfolio. If you remember back to the decade of the 70s, what happened to people's bond portfolios or their stock portfolios or their ability to afford goods and services on their pension, their paycheck, or on their savings, the 1970s, except for people like me who were lucky, was extremely painful. What gold really does is it insures you against the depredation of the purchasing power of your savings by your government. Sadly, I feel that's inevitable.
Government debt has become one of the defining economic challenges of the moment. Rising interest payments, persistent budget deficits, and expensive refinancing costs are pushing policymakers into increasingly difficult corners. Beyond public debt, households and businesses are facing their own mounting financial pressure through mortgages, credit cards, and corporate borrowing. History shows governments often respond to this kind of squeeze by expanding liquidity, propping up financial markets, or easing monetary policy. While those moves can stabilize markets in the short term, they can also chip away at money's purchasing power over time. One reason precious metals keep drawing attention as long-term stores of value.
For me, there are other people who are perhaps more adept as traders, or at least or at least perceive that they're more adept as traders, for whom gold is a trading asset. It's a casino chip. I'm not one of those. I save in gold. I invest in very, very high quality equities, and I speculate on lower quality junior equities. To me, gold isn't a speculative asset class. It's a savings asset class. There are others, probably many of them listeners to you, who speculate on gold. Some of them are probably better at that than I. Most of them probably not, but yeah, I mean, not close to the top, frankly. If I think I got an average of 75, I think the top was 115. Okay. By the way, I didn't begrudge a dime of what I missed. That's not what I do. My physical silver was different than my physical gold. I considered it to be a speculative asset class. I owned it in my portfolio because it was hated. And I surmised when I bought it that when it ceased being hated, I would sell it. If you dial yourself back to January, silver was anything but hated. There was a parabolic upchart. And I always sell parabolic upcharts. I mean, maybe not if they accompany a spectacular drill hole. But parabolic upcharts in the absence of sustaining news, I sell. Silver ceased to be hated, so I sold it. I guess you could call that a trading strategy, but frankly, the round trip in that trade was probably 5 years. I proved to myself in 2009, I proved to myself that I can sell gold psychologically when there are other asset classes that are so cheap that I want to dip into my savings to buy those asset classes, I actually can use gold as liquidity. That hasn't happened very often, but in 2009, you'll recall the aftermath of the 2008 financial collapse. Gold collapsed along with everything else, but it came back very, very, very quickly. And by September or October of 2009, there were some other assets that I thought were stupidly underpriced. And the consequence of that is that I sold a reasonable bit of gold to load up on those assets. In hindsight, to my advantage, I had no idea that the gold price in 2011 would collapse too. I wasn't smart enough to believe that. But I remember there was one stock, Kinder Morgan, a great big pipeline company, structured as an MLP. And, sort of the dominant player in oil and gas transmission where it operated, selling for a 13% tax advantage current yield. I thought, I have a huge sense of humor for this. It does that. It does something else that's rare for a 73-year-old like myself. It allows me to sleep nights and stay calm. As I age, I've come to understand, at least for me, that part of the essence of wealth is to enhance your sense of well-being. And gold literally enhances my sense of well-being. When I look at what I think is likely to happen to the purchasing power of the dollar, and when I think about the likely social and economic consequences of that, I think liquidity is going to come in handy. Imagine, Maggie, if I'm right, that the US dollar loses 75% of its purchasing power. Imagine somebody who today lives on a $3,000 a month pension, and it then takes $12,000 to buy what $3,000 buys now. Imagine the response of the pensioner as a voter. Imagine that not merely for pensioners, but for people who believe that their savings were adequate. Imagine it for people who have contestable job skills where they can't change their remuneration based on their contribution to their customers. I lived through this in the decade of the 70s. I lived through a period where people whose skills in society were such that they didn't have the ability to increase their compensation as the cost of everything increases. And I think a substantial amount of the social turmoil and unrest that we experienced in the decade of the 70s could be traced to the fact that people thought they were getting a lousy economic deal. I'm not suggesting that the next 10 years will see that, but I'm not suggesting it won't either. And the ability for me to shelter my purchasing power in gold, have an asset that isn't simultaneously somebody else's liability. Gold is not a promise to pay. It's payment in and of itself. For all those reasons, as a saver, I want to save in gold. My experience tells me yes. I'm not sure why, by the way, Maggie, but I can tell you that 4 times in my life, momentum in the gold price has attracted the generalist investor to the precious metals narrative. And when that occurred, including late 2025, the leadership changed from gold to silver. When the generalist investor comes down into the precious metals ghetto, in my experience, the silver price always outpaces the gold price. I'm surmising that's because of silver's reputation for upside volatility, and also because of its lower unit cost. But the truth is, I've been trying to figure out why it happened for 50 years, and I actually don't know.